Hello, delegates of the Retired Public Employee Council of Washington. My name is Hank Kim, and I'm the Executive Director of the National Conference on Public Employee Retirement Systems, also known as NCPERS. I appreciate being invited to speak at the 46th Biannual Convention. While I truly regret I am unable to join you in person, I hope this short video will add value to your convention and educate you on a few top issues facing public pensions in our nation's capital, or as you might think of it, as the other Washington.
So as we switch to a presentation, over the next 20 minutes, what I'd like to do is give a quick introduction of my organization for those of you who may not be familiar with NCPERS, and then spend the balance of the time talking about where public plans are, where we came from, and what the issues are that members of Congress and other bodies here in Washington, D.C. are doing relative to public pensions. So, regarding my organization, the National Conference on Public Employee Retirement System is the largest trade association for public sector pension plans. We have over 500 members throughout the United States. We even have some members in Canada as well as a member in Australia. And collectively, all 500 public sector plans have more than $3 trillion in assets under management. And as a trade association, we do what a typical trade association does here in Washington, D.C., which is to advocate on behalf of our members, conduct research to find out more about ourselves, and provide education to stakeholders of public pension plans. In the past, we used to consider stakeholders very narrowly and limited it largely to our members and the trustees of the board of pension plans and staff. But over the years, particularly after the great financial crisis, we've really expanded our definition of stakeholders, and we try to bring our education to all folks who are affected or invested in public pensions. So certainly our members and the various components of public pension plans, but also retiree groups such as yours, or unions, employers, and the taxpayers in general we consider as stakeholders. And you can find out more about us on our website. So let's talk a little bit about where the American retirement landscape is currently. And what I've done is broken up the total American savings into sort of three trunks. First, we have the private sector. Then in the middle column, we talk about state and local plans. And then over here to the right, we'll talk about the federal government. So beginning with the private sector, the data that I'm about to cite to you comes from the US Federal Reserve System. They publish it on a quarterly basis, and this is the most recent data that we have. And again, according to the United States Federal Reserve, in the private sector, there's over $3 trillion of money in defined benefit plans to benefit workers in defined benefit pensions. And there's more than double that amount, almost $6.25 trillion in defined contribution plans in the private sector. And when we talk about defined contribution in the private sector, largely we're talking about 401k plans. So together, it's about $9.27 trillion worth of savings in the private sector. Now let's shift over to state and local plans. And as you can see, we have over $4.2 trillion in defined benefit pension plans and just under $500 billion in defined contribution plans, such as a 403 plan or 457 plan. And then in the federal system, we have just under $6.7 trillion in defined benefit plans and about 566 billion in defined contribution. That's mostly in the thrift savings plan, which is the federal government's version of a 401k. And to provide a little bit more context, I want to give a couple more data sets, which is to give the scale and magnitude of the workforce in the private sector, state and local government, and the federal government. So the data I'm about to use now comes from the Bureau of Labor Statistics, which is a part of Department of Labor. And in June of 2018, again, very recent data, according to BLS, the total US non-farm labor workforce is 149 million Americans. So 149 million Americans are of working age. Of that 149 million, 126.4 million, or representing effectively 85% of the workforce, is in the private sector. So 85% of the workforce is in the private sector, and they've saved just over $9.2 trillion for retirement. In state and local, we have just under 20 million, 19.6 million workers in the state and local workforce, which accounts for just over 13% of the U.S. total workforce, and which means for 13.2% of the workforce, we've saved nearly 4.7 trillion dollars. And then lastly, for the federal government, it's 2.8 million civilian employees of the federal government. We're not including the military in here, which accounts for about 2% of the total workforce. And 2% of the workforce saved $2.24 trillion for retirement. And so I think what hopefully you're getting an understanding of is, while certainly some state and local pension plans have issues, the real concern relative to retirement and retirement security for America lies in the private sector, where 85% of the workforce is located, and it only has $9.27 trillion worth of savings for retirement. Relative to the history of public pensions, we have more than 150 years of proud history of public pensions. One of the first, references to public pensions it comes from New York and the city of New York precisely, where in 1857, the city of New York established essentially a lump sum line of duty benefit for police officers, and that if they were injured or killed in the line of duty, the officer or his or her beneficiary would get a lump sum benefit. That line of duty lump sum benefit was extended to the fire department of New York in 1866. And 12 years later, that lump sum benefit for police and fire morphed into or evolved into what we would consider more of a traditional pension. And it essentially became a proto pension for New York City police and firefighters, such that the city said, if you have served the city for 21 years and have reached the age of 55, at the end of your career, you would get a steady income from the city until you pass away. And that proto pension was extended to New York City teachers in 1894. And many pension plans at both at the state and local level came into being soon thereafter. And there was a real boom in terms of statewide pension plans soon after 1935. And it, for some of you who are more observant, you would know that 1935 is auspicious because that's when Social Security was passed. And at the time Social Security was passed, our understanding of the Constitution and constitutionality of taxation prohibited effectively federal and state employees from joining Social Security. So when Social Security was first authorized and enacted, it really was only for those in the private sector. And as a result, states and localities soon realized that they needed to catch up to essentially compete against Social Security relative to a pension plan. And so many statewide plans came in soon thereafter, 1935. And even to this day, you see the remnants of this history of excluding public employees from Social Security, where large bulks of state and local employees are still outside of Social Security, largely in education and in public safety, but really in almost all fields at the state and local level, you can still find workers who are not covered by Social Security, and their pension is a substitute for Social Security and their retirement benefit as well. So, that's a quick history of public pensions. Where are we now? The data relative to some of this is slightly different because we're using a different set of data from the United States government. This time we're using data from the US Census Bureau. And according to the United States Census Bureau, we have just over 5,500 state and local pension plans. Covering 20.6 million participants and having assets over $4 trillion. Our plans are contributory, very unique in that employees contribute towards their own savings. This does not happen in the private sector with their DB plans. And as we talked about, Social Security does not cover large segments of public employees. And unlike private sector retirement plans, we are not governed by the federal government through ERISA. We are governed and regulated at the state and local level. So in terms of pension advocacy, shifting gears and talking about those issues that we try to cover both in Washington, D.C., as well as at the state and local level. If you come to our website and go to advocacy by clicking on this link up here, it'll take you to this landing page. You'll see a number of advocacy activities, a code of conduct that we've formulated for those who service public pensions. So, asset management companies, law firms, accounting firms, actuarial firms. These are a code of conduct that we expect of these vendors. Secure Choice Pension, which is an effort to bring retirement security to the private sector, particularly those who work for small businesses who do not have access to an employer-sponsored plan. We came up with the concept of having states establish a Secure Choice retirement savings program. And one of the fruits of this effort are the Washington State marketplace for retirement savings plan, as well as Seattle's Secure Choice program that's coming online very shortly. And one of the resources you will find in our Advocacy Resource Center is our annual legislative issues book. This book is not only a reference material, but it really helps our members, read about the issues that we're concerned about in a good level of detail. And it's a good leave behind for policymakers so that they understand the concerns that we have as a trade association and the reasons for the concern and any solutions that we may offer. So you can find copies of our issues book on our website. And if you were ever to download our issues book, some of the things that you would see in this year's is has to do with tax reform, um, also about confusion that may come up as Congress debates and decides how to best handle multi-employer plans in the private sector. And we'll talk a little bit more about both of these things momentarily. So in terms of comprehensive tax reform, one of the first things I think we need to recognize is there is a conflict, a balancing act relative to the federal government's perspective of trying to have policy that promotes retirement security versus trying to generate revenue from taxes. That if you try to increase retirement security, it will probably have a negative impact on tax revenue. And if you try to increase tax revenue, one of the negative impacts could be retirement security. And let me explain why. So here you see a slide of where money and potential revenue could be found for the federal government. And the top line says the federal government over 10 years could raise nearly $80 billion if instead of having 401k plans and 403b plans and 457 plans, instead of employees contributing money on a pre-tax basis and letting that money grow on tax-free, and then at the end of their career, when presumably they are on fixed income and are retired and therefore at a lower marginal tax rate, then get taxed on the distribution of these defined contribution plans, that instead you turn them into Roth plans, meaning that you pay the tax on the contribution beforehand, then put the money in, the post-tax money into the account, let it grow tax-free, and at the end of your career, when you retire, you get distributions from this Roth account tax-free. If you converted that from pre-tax to post-tax, the federal government would raise nearly $800 billion. The second change that the federal government could do to raise revenue is to no longer allow businesses to deduct the contributions that plan sponsors make, businesses make for their defined benefit plans. So as I mentioned earlier, the public sector is very unique in that for our defined benefit plans, employers and employees make contributions into it. In the private sector, if you have a DB plan from say, Exxon, that contribution for the DB plan comes solely from the employer, but the employer gets to deduct that contribution on their tax returns. And if the federal government were to get rid of that tax deduction, they would raise nearly $500 billion over 10 years. And then finally, something that does apply directly to public sector pension plans is the repeal of pickup, which is a fancy way of saying, we talked about how it is so unique that in the public plan space, state and local government pension plans, that contributions by employees are done on a pre-tax basis. That ability for employees to make that pre-tax contribution into the DB plan is called pickup. And if the federal government got rid of that, it would raise approximately $5 billion over 10 years. And so when you add up all these three areas, you get about $1.3 trillion worth of potential revenue for the federal government. Now, remember, when the federal government enacted the recently passed Tax Cuts and Jobs Act, we fell in the hole, we as a nation fell in the hole by $1.5 trillion because the revenue that the federal government was giving up was not made up for. And so if the federal government ever chose to try to close the gap, either on the original tax cut, or if there's an appetite to do a tax cut or tax reform 2.0, this $1.3 trillion starts looking very, very tempting. So this is where we are in terms of tax reform. If they ever do taxes again this fall or in 2019, I think things that we would need to keep an eye out for are the UBIT, Public Employer Pension Transparency Act, also known as PEPTA, Rothification, which is what we just talked about converting pre-tax 401ks into post-tax 401ks, and annuity accumulation plan. And I'm going to spend a few minutes just talking about each one of them very briefly and then wrap up. So UBIT stands for Unrelated Business Income Tax, and it applies to essentially nonprofits who engage in commerce that is outside the scope of their nonprofit purpose. So one very illustrative and historical example of this is when New York University, a private university, a nonprofit university in New York City, back in the 1970s, got in the business of running a pizza parlor. It was decided back then that running a pizza parlor was not part of the core mission of NYU, which is to educate college graduates, and any revenue derived from running a pizza parlor would be taxed as an unrelated business income. So how does UBIT apply to public pensions? Well, there are some folks who argue that when public pensions invest in certain classes of assets, that it is outside the core mission of public pensions, and it competes in the marketplace against private sector entities. Generally, what they're referring to are alternative investments like private equity, hedge funds, real estate investments. And that as a result, if you buy that line of argument, then those revenues generated from these types of investments should be taxed as unrelated business income tax. And when you tax at UBIT rate, it is the highest rate, which is now 35%. The IRS has a long-standing rule that basically says that public plans are exempt from UBIT. But again, there were some members of Congress who felt otherwise, and they tried to pass in the Tax Cut and Jobs Act a provision that would apply UBIT to public plans. And it was in the House version of the tax cut bill. The Senate bill did not have it, and when it went to conference, due to lobbying on NC PERS and and more importantly, from our grassroots lobbyists, meaning our members, meaning participants and unions and others, we were able to essentially kill the UBIT provision in the conference report, and it went away. So the folks who want UBIT are still part of the House of Representatives. If there is ever an effort to do tax reform or any sort of retirement or tax efforts going forward, I think UBIT for those folks would be a major consideration. So again, this is why we want to keep an eye out on UBIT. PEPTA. This has been legislation that's been introduced for a number of years now, almost going on 10 years. It is, the prime sponsor is Representative Devin Nunes from California. It is currently reintroduced in this Congress. It was reintroduced earlier this summer, about the end of July, I believe. And what it would do is it would require public plans for the first time to report its funding status using two sets of numbers. One is to calculate it on the current assumed rate of return, sort of our historical or anticipated return, given the asset mix of pension plans. And then a secondary number based on what is considered, in air quotes, safe discount rate or safe rate of return, which is the Treasury yield curve, which currently is just over 3%. And as we talked about, one of the unique things about public pension plans is we are not regulated by the federal government. And if PEPTA were ever to come into being, it would be unprecedented for making state and local plans now, become regulated by the federal government via annual reports to the Treasury Department, and B, making public plans use an artificially low return assumption to calculate our funding status. As you know, the lower the return assumption, the higher the unfunded level will become. And in our view, this is really an effort just to embarrass public pensions. There is no real legitimate reason for the federal government to require annual filing. It would be, it would cost not only administrative but real dollar costs to the pension plans to make these filings. Rothification, we talked about this earlier, so I'm going to skip over that. And then finally talk about the annuity accumulation plan. And so this has been introduced for the past 4 years now. And it's sponsored by Senator Orrin Hatch, who is the chairman of the Senate Finance Committee, which is the tax committee that really has jurisdiction over tax issues. And what it says is, if it were to pass, it would allow, the federal government would allow states to essentially close their public pension plans, and instead of making contributions to the pension plan, use that money to buy annuities for its employees from annuity companies and insurance companies. But not only that, but this, as currently written, would tell states to buy annuities on an annual basis. And at the end of a state and local employee's tenure, all these various annuities that have been bought for him or her over their career would then get squished together, and whatever that squishing amount is, then becomes essentially their retirement plan. We think this is really unworkable for so many reasons. One of the primary being is this annual bidding RFP process for segments of annuities, so that if someone works 40 years, it's conceivable that that individual would have 40 different annuity slices that they would have to put together and cobble together to make their retirement. And so there are other issues beyond that, but for time consideration, I won't go into it. And again, I ask you to go onto our website and look at our issues book for a further detail of the annuity plan. Finally, Congress is looking at multi-employer plans. Multi-employer DB plans are those also known as Taft-Hartleys. You may have heard about these plans from your brothers and sisters in the private sector unions, but essentially these are largely in construction and building trades and in trucking, where employers get together and collectively bargain with the various unions to create a single plan for all these various employers and union members. Unfortunately, there are a number of these multi-employer plans that are really facing insolvency issues, and Congress has created a select committee to look at how best to determine the future course for some of these pension plans. This select committee is slated to provide its recommendation at the end of November of this year. And the concern is that there are some people on the committee who either knowingly or unknowingly want to confuse multi-employer plans and public pensions. And while there are some similarities between multi-employer plans and public plans, there are vastly different issues relative to multi-employer plans and public plans. And for us to get sort of bootstrapped into any solutions for multi-employer plans would be disastrous. And so we are more than happy to talk to Congress about any public sector DB plan issues, but we would like to have those conversations separate and distinct from any conversations and solutions for multi-employer plans. So again, I thank you for having me, and again, I apologize for not being able to join you in person. Hopefully our chat has enlightened you on some of the things that we're looking at, and hopefully it gives you a little bit more perspective on where pensions and some of the pressure points that public pensions are facing in Washington, D.C. I wish you a good convention, and hopefully I'll be able to join you sometime in the future in person. Thank you so much.